Very good afternoon to all of you. On behalf of Institute of Chartered Accountant of India, Auditing and Assurance Standard Board of ICAI, I welcome you all in today's 99th CP program organized by AASP of ICAI. Today, the topic is very, very important and very relevant in today's time. That is the key considerations in the audit of real estate sector. In order to tackle this very important topic, we are having with us our own chartered accountant fraternity, our own very learned speaker, C. Nikunj Shahji. So, on behalf of WSP of ICI, I welcome Nikunj on this 99 CPE program organized by WSP of ICI. Welcome, sir. Our honorable chairman sir and vice chairman sir has stuck up in one of the meeting. That is why we are starting the proceedings of this webinar. And it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C. Nikunj Shahji. C. Nikunj Shahji is associate member of Institute of Chartered Accountant India and is a partner with Assurance Practice in SR Botley Boy and Assurance LLB, Bangalore office. He specializes in financial statement auditing and is having more than 15 years of audit experience of working with large multinational and listed companies and entrepreneurial growth companies. He has extensive experience in audit engagement of real estate companies through his knowledge and good business acumen. As a part of his thought leadership initiative, he has presented auditing and accounting topics at various internal and external forums. So, without wasting much more time, I request Shri Nikunj to please enlighten all of us on various intricacies on key consideration in the audit of real estate sector. Over to Nikunj, please.
Yeah, thanks Anilji. Thanks Anilji for that lovely introduction. Okay, so just to give an insight to all the members, maybe I'll just share my screen first. Just let me know once the presentation is visible, Anilji.
Yes.
Yeah.
Yes, it is fine. Fine.
Yeah. Fine. Yeah. So firstly, before I begin, I'll just take this opportunity and thank the ASSP board and Anilji and the chairman sir for giving me this opportunity of sharing my experience of when encountering audit of especially the real estate clients and just highlighting the key challenges what as an audit fraternity we are facing it. So thanks once again. So just to give an overall summary before we delve into the key audit consideration, I'll just summarize to all the members who are present in the webcast, right? What we will go through is that while I have the approach is that I will not go into too much of auditing jargon and all that. The approach is just to highlight the key auditing and accounting issues which we as an audit fraternity we have encountered when auditing the thing and how best we build a robust audit procedures around it so that our the documentation around it and our audit opinion is on the true and fair view is protected. So that's the key thing, and I'll try to keep it as simple as possible by giving some examples so that we all could be able to correlate with what the challenges are coming out. And as Anilji mentioned, equally important is that I think we all know that with so much of regulatory focus, right, coming in this sector, more and more onus is on the auditors, like how they are well equipped from a real estate sector doing the audit here, because we all know, right, we had a lot of cases of real estate clients wherein there were a lot of regulatory oversight by the regulators, and the expectation from the regulators is that as auditors, I think a greater onus is being put on us to highlight if any issues we have encountered. So with that thing in mind, I'll just move on to the next slide. Yeah. So as you see, what I have done is that this is just a brief overview of the real estate market in India before we dwell upon the key audit consideration. So as you all know, from an entire landscape of real estate, right? I think the post 2007, 2008 financial fiasco, I think there was an upward demand in the real estate sector. But again, when post the GST and demonetization, there were a lot of, I say, in the real estate market. It was already reeling under the pressure of the demonetization and GST. And with COVID coming in, there was a lot of slow down, and especially in the real estate segment market. So when I say real estate segment market, the residential sale market. But I'm just, this is just to give an entire flavor to the entire participant, is that this is more of a futuristic data points which I have just shared in this slide, which will just help us in the entire growth journey of the real estate sector in India. So post COVID, now what I have generally seen in the market is that there has been a lot of improvements, especially in the real estate sector from an India perspective, be it the commercial segment, the real estate sales also, they are back to the pre-COVID levels, at least the big players, if I can see. So with that in background, it is almost expected that the real estate market would touch 1 trillion by 2030. If you see already 2021, it had touched 200 billion, the total market. And from a GDP also, it is around 4 to 5% of GDP. And the expected by 2030, the real estate segment in India would almost cover around 13 to 14% of the GDP. So that just gives an overall importance of the real estate sector in India, and as an audit fraternity, what is the opportunities available. Second, I think this we have been seeing there is a lot of relaxation in the FDI and now 100% FDI is allowed in real estate sector. So it is, in terms of FDI inflows sector wise, real estate is the third largest. And again, just to say that a lot of focus is there on the P investor guys or the foreign investor guys. They expect as auditors from us to at least give them a sanity check or the level of quality when we audit the real estate clients. Moving on, again, from an greater focus by government, I think this we have seen it. We already had the GST implemented from a regulatory oversight. There is this Pradhan Rozgar Yojana, wherein housing for all. There is this new development of public-private partnership. So all this is giving a huge impetus to the real estate sector. Next, if I can say, is that again there has been a huge rise in institutional investment in real estate sector. So when I say institutional investment means what? So institutional investment, this is something which we have been seeing for the past 2-3 years, is that large fund houses, be it the Blackstones, the GICs and all that, there has been a lot of investment by this institutional investors in the India sector market. So this clearly shows that the growth potential in India market as compared to other markets, they are harping on the Indian economy, and it is just going to increase. Again, from a stronger governance. So this is again from an government, if you want to say government policies, decisions. By and large, India real estate was unregulated. I think the biggest change, if I could say, which came 4 or 5 years back, was the introduction of the RERA Act, Real Estate Regulatory Authority Act. I think some sort of a governance framework was set, and which was very well much needed in this real estate sector. And as auditors, it becomes equally important that we are aware of this entire RERA framework, because one of the key criteria when doing audit is that even to see audit of the laws and regulations surrounding the real estate sector. So this is one of the key regulations where as auditors, we have to be very, very thoughtful and updated. Again, GST, I think we all know the GST impact on the real estate sector again. And then the introduction of the amended Benami Amendment Act, again, just to have a more of a transparency in the real estate sector was introduced. So that again was a very good push from the government. Coming now to the last two things, this is just, I'm just highlighting more from what we have seen generally post the COVID scenario. Yes, at COVID, the real estate market was impacted. So one thing which definitely stands out, and say if I want to say from a residential market, is that the smaller players are, what we have seen is that they are still in that financial difficulty. They are not able to execute the project. So this is something which we should be very, very well be aware whenever we are auditing our clients. There is still a liquidity crunch from a smaller players, but what we have seen generally is that there is a lot of consolidation happening. So the weaker players still are struggling, but there is a lot of consolidation. Even big companies, they are entering into a joint venture with other real estate developers, other PE investors in India or outside India, to at least revive post the COVID pandemic. So this is something which we are seeing a lot of traction in real estate market. Coming to the new segments, sunrise segments, I would like to say, I think we already have seen REIT pretty much a new investment vehicle to say REIT. I think this has been a standout performer for the past 2 to 3 years with the returns which the REITs gives in commercial market. I think the best transparency was that the entire REIT regulation requires auditors requires the company to mandatory distribute dividend to the unit holder. So that is something which there has been a lot of what you have to say is that a lot of investment opportunities which all the real estate developers are seeing in building a REIT environment. Coming to the next thing is that it's more from a warehousing and data centers is another thing which we have seen a lot of traction around that. So now moving on to the next slide. This is just before we begin, before I discuss on the key areas, audit areas impact, this is just a broad overall framework, right? We all know, right, from a audit of any sector and particularly real estate sector, it's equally important that we understand the risk in the sector. And as mentioned in SA 315, I think the first and foremost as an auditor, we should be mindful is that what are the key risk factors in the real estate sector? Okay, what are the key risk factors which would trigger, or there is a possibility of a risk of material misstatement in financial statements? So I have just summarized some of the key risk factors which generally on a common real estate industry per se are there. And as auditors, how we should consider when performing our audit procedures. So with that framework, SA 315, if you can just see on the slide, typically first is from a revenue transaction. And from a revenue transaction, I'm just highlighting more from a residential sales vis-a-vis commercial sales, because commercial leasing, you have an agreement and it is in line with the agreement. So this is more to focus from a residential sales. So one of the key factors from a residential sales is the possibilities of leakage or fraud in revenue. So just to give all the members a perspective is that by and large, I think as auditors, we all know, right, revenue recognition is the biggest significant risk or fraud risk per se in a real estate, right? The way the entire real estate sale is structured, I think there is a lot of opportunities available to the management, lot of bias is there to either increase or decrease the revenue. So by and large, by default, I have generally seen in my experience is that we identify revenue recognition as a significant risk or a fraud risk based on the understanding of the sector and the entity. The second most important key risk factor is from a cost accounting or the project accounting, which I have summarized in the form of subcontractor claims or cost inflation. This is again very, very important to ensure the correctness or appropriateness of the project cost accounting. And we will see what are the key audit procedures around it to give a comfort as an auditor when auditing around that. Another key aspect, I think this is again from a broad framework, and this I generally have seen as auditors, we sometimes miss to see from an overall entity level control vis-a-vis when we do an audit procedures at an account level. So the third one, which I'm mentioning, is on the vendor selection process. I think this is a very, very important as auditors when we audit real estate clients is that we go through the entire, understand with the management, the entire vendor selection process, the way the industry, they work, because there are a lot of models, right, in which a real estate company works. They will have a subcontractor model. There will be many cases where they directly deal with the vendors. There is a combination of material purchases. There is a combination of a contractor, RA bills, and then you have the other services involved. So this is one of the key risk factors. I think it's very inherent to the real estate industry. And from an audit framework point of view, it becomes equally important that as auditor, okay, we at least have an understanding of what is the framework management has adopted, be it from a vendor selection process, be it from a vendor evaluation, like whether they have, I'm just giving an example, whether the company at least have a process of inviting quotations for selection of vendors. Is there a benchmarking study being done when they select the vendors? So these are the certain things and evaluation. Are they relying only? There could be even cases wherein you could have one sole vendor because of the expertise, but is there a timely periodic review of that vendor? So this is something which just gives us an more of an insight of the entire, how they do the entire procurement business of a real estate industry. And it's equally important how we do audit around that. The fourth one, which I mentioned, is on the construction estimates. Now, why I have mentioned construction estimate is that this is construction estimates directly impacts the financial statement numbers. As you know, right, many of the real estate sales is driven by percentage of completion method under Indian GAAP accounting. So this is very, very important that the audit rigor around construction estimates, we have the appropriate documentation in hand to support that the estimates is updated, because any change in the estimates, or if the estimates are not updated, it will have a significant impact on the financial statement numbers. So this is again a very key area of concern as auditors. We have to be, while doing audit procedures around estimates of construction budget. The last one, I think off late, I think we have seen this, many of the cases, it's coming in news sometimes saying that there are a lot of real estate companies based on the regulatory review or regulatory inspection that there has been a fund diversion. So I think as auditors, we have to be very mindful, like how from an overall framework or the entity level control which the company has, what is their funding policy? Why I'm saying is that it is not that management is intentionally doing it. Sometimes I have seen in my personal experiences that management, it is in line, management believes that the funding or giving it to the funding to group companies, it is in line with the terms of the contract. So I'm just giving an example, like most of the real estate framework, you will see that there is a holding company. It gets, it has borrowed funds from the external bankers or financial institution, and it typically gives even loans to its subsidiaries or group companies for the real estate purpose. So that is a typical structure under which the real estate funding works. But now as auditors, I think we have to be equally very, very careful evaluating the terms of the sanction of the bank. Like, is it really the application of funds? If I give it to a group company as an ICD or a loan or an investment, is it in line with the terms of the loan agreement? And this has become in focus in view of the current CARO requirement as well. So just to give an update to all the members in the CARO requirement, I think many of you know, right, that as auditors, they have referred an RBI circular as well, wherein they have mentioned that any term loans which any entity has taken any application of funds has to be in line with the RBI circular. So in RBI circular, there are certain negative covenants which they have mentioned, wherein the company cannot utilize in any format any bank funding which they have taken. So that's why I'm just highlighting this fund. The application of funds becomes equally important when we do the audit of the real estate companies. So this is just the broad key areas which I just wanted to give you a flavor. And below the slide, so these are the key areas of real estate which I'll be taking, and we all will be discussing more from what are the peculiar challenges as auditors we have encountered while auditing around it, and what are the key audit procedures we should perform around that. So be it revenue recognition, which I discuss, is anyway inevitable as the key area. Construction budget is the second thing. Another typical thing which we had encountered, I think we all know from a real estate, is that most of the real estate companies who are in the business of residential have a lot of advances or deposits which we pay towards land procurement. And considering the real estate life cycle, sometimes it goes to, the gestation period itself goes to around 5 to 6 or sometimes 8 to 9 years. So considering that the entire tenure of the land advance which is sitting in my balance sheet, right, company's balance sheet, it is a very key area of audit focus from a real estate sector. Coming to the next one, be it the real estate inventory or the investment property or fixed assets. Again, one key focus is the valuation or assessing impairment. Again, we'll discuss on that. What are the key audit procedures as auditors we have to be cognizance of while auditing that. Related party transaction, I think we all know. I think it's inherent to real estate industry, I would say. I am my view on this is that it's not that it's we have to always be questioning that, because it's a part of the real estate structure group, be it the way the real estate industry is structured. But yeah, I think equally important as auditors is that there is always a possibility, since there are a lot of the entire related parties within a real estate RE group. When I tell of a real estate group which has almost 40-50 group companies below it, there is always an opportunity for the management, okay, to have a bias or do a transaction which may be outside the ordinary course of business. So this is something which, as auditors, we should be mindful. And I think we had cases wherein there were certain transactions with related parties. As far as that they are in the regulatory framework, we have, and it has been appropriately documented, approved by the board minutes, I think we should be very, very careful, and adequate disclosures by management. That should be our key consideration from an RPT transaction. And also the comfort on the true and fair view of the financial statements is equally important from an RPT. Another risk area is on this entire investments and loans and advances we would be discussing. I think the biggest challenge as auditors when we audit all these loans and advances particularly is, again, you have long outstanding loans and advances which you would have given to companies which are in the real estate development, and our concern is more on the how they will monetize it. So again, this is something which we have to be a careful evaluation. Then coming to other parts, I'll just quickly dwell on certain challenges around borrowing cost capitalization. I think it's equally important as auditors, like we are aware of the borrowing cost capitalization, or what could go wrong from an audit perspective, wherein the management may not have done the borrowing cost capitalization appropriately, and highlighting the same to the management. Again, from other areas like going concern, deferred tax on losses also are equally important, especially in this scenario, and wherein we have seen certain sectors, they are not able to generate sufficient cash flows, and how as auditors, we are comfortable on the going concern assumption which has been done by the management. So this is an overall structure. I just thought I'll just give you. One is from a framework perspective. I think I'm just summarizing it. From an understanding of the company, it's very important that any real estate company, when we audit, we understand first the entire business structure, identify what are the key significant of fraud risks, and then we do an entire audit procedure, because it may it is inevitable that the moment you identify any areas as key risk factors, you have to do an additional audit procedures or additional control testing around it to get a comfort vis-a-vis a routine matter. And this is generally what we have seen, or I have seen based on my past experiences in auditing real estate sectors, that requires additional focus attention from the auditors. So moving on. So we'll start with, I think the key thing, revenue recognition auditing. What are the key audit consideration from a revenue recognition in real estate? So before I begin, or before we dwell on the key audit consideration, I thought it's better if I give a flavor of what is the accounting impact, or what is the accounting requirement for real estate. I think this is very, very important. I think most of us know the requirement of accounting, what is the current accounting requirement for real estate. But I just thought I will summarize this first, so that based on this premise or this background, once we know the entire framework, what is applicable accounting framework for real estate. And when I say real estate, again, I'm emphasizing this on residential sales apartment and not on the commercial leasing piece. This is purely from a residential sales. what is the current accounting framework, and based on that, what are the key audit considerations. So if you see this slide, I have just summarized both. I have dissected both one entities which are under current Indian GAAP and entities which are under Ind AS. So just to give you a background, I think from an entity which are involved in revenue or revenue generation from sale of apartments or sale of units, there was no specific accounting standard under Indian GAAP which actually addresses the accounting model. So you had this AS9 revenue, which typically AS9 was more towards dealing with revenue from sale of goods or services. And then we had this AS11, which is on construction contract, which was pure play construction contract. But the way the residential real sales happens, because it's not a pure end-to-end construction contract, because it is again dependent on the ultimate sale to the customer. I can have a case wherein I build a building. Maybe I'll be selling only at the end of the completion term as a management strategy. So AS7 may not equally apply, and equally AS9 also won't apply. So I think there was a lot of deliberation among the accounting fraternity and auditing fraternity, and ICAI had issued a guidance note on accounting for real estate transaction. This was issued in 2006, and again it got revised. So currently how it stands is, under Indian GAAP, there is a guidance note which has been issued by our ICAI, which is called Guidance Note on Accounting for Real Estate Transaction, and which gives a guiding principles on how you should account, or what are the key conditions based on which an entity should recognize revenue for residential sales. Now, if I just dwell on ICAP, I think the principles are broadly based on AS9 and AS7. So what it says is that typically, before going through the underlying principle, I think you all know, right, that typically residential sales, the way it works is that you will have agreements with customers during the construction period as well. It's not that I will only sell the apartment at the end. There are cases where the sales of the apartments happens during the construction of the project as well. So I think the key challenge was to the entity how they should recognize revenue when they, during the development of the project, and parallelly I'm selling based on agreement to sell, I'm selling the units to the customers. So I think broadly the principle what was coming from the guidance note is that it was more of a risk and reward model, right? Considering the terms of the generally we have seen now based on the customer agreements which the companies enters with the customer for units which are at the construction phase. Based on the broad terms, I think 9 out of 10 companies was satisfying the principles which was mentioned in the guidance note on accounting for real estate transaction, which was the basic premise was there is the significant risk and rewards are being passed from the company to the customer. Okay, not the control, it's only the significant risk and rewards are passing. And in case the significant risk and rewards are passing during the construction phase, then an entity can apply percentage of completion method. So by and large, under Indian GAAP, it allowed percentage of completion method, provided the significant risk and rewards based on the terms of the agreement, the entity was able to substantiate it. And we have seen mostly under Indian GAAP and even under Income Tax Act as well, all the companies are offering revenue under percentage of completion method. So that is one aspect from an Indian GAAP. Coming to Ind AS also, just to give you a background, before Ind AS 115, a similar guidance note was issued for Ind AS as well under ICAI, which allowed percentage of completion method. Based again, the basic premise was significant risk and reward. But with the adoption of Ind AS 115, which came under Ind AS, now I think all the guidance note has been withdrawn, and now all companies which are under Ind AS framework has to follow Ind AS 115. So this is a very, very important accounting consideration for entities which fall under Ind AS 115, because the basic guiding principle under Ind AS 115 is the control model. And there is an entire detailed literature from a real estate sales under which category it will fall. So just to summarize or give a knowledge to the member fraternity here, under Ind AS 115, it's more of a control model, wherein it says that during the course of construction, if any entity is selling apartments to the customers, okay, are they transferring control during the construction phase? Or even if they are not transferring control, does the entity have a right of payment of the work done till date? So it's more of a rigorous test as compared to risk and rewards. The test under Ind AS 115 was more towards saying right of payment at any point of time. Now, what we have generally seen based on our experiences or based on the current terms and agreements which most of the real estate companies have, because now the entire agreement is being governed by RERA regulation, right? The experience has been is that there are again two alternatives. There are certain companies who are able to meet the control model test during the course of construction as well. So for that companies, they can still follow a percentage of completion method under Ind AS 115. But by and large, we have seen that most of the companies are not able to satisfy the control model or is specified in Ind AS 115 of recognizing revenue over the period. So when I say over the period, is again recognizing revenue based on percentage of completion. And why was this? Was because the key condition in Ind AS 115 was that the customer, even suppose he cancels, because there is a risk of cancellation during the construction period. If the customer cancels during any part of the development period, does the entity have a right to collect the amount of work done till date? If that condition is satisfied, then yeah, control is getting transferred. You can account based on percentage of completion method. So that was the crux under Ind AS 115. Which generally based on the terms, generally we have seen the terms are that the customer can cancel anytime. The developer will retain around 10 to 20% of the amount as a retention fee, and the balance anyway they have to refund it back to the customer. That's the broad, I'm just saying broad framework from a RERA regulation, but there could be cases wherein the company would have entered into agreement with customers of making it a non-cancelable thing. So there are a lot of legal interpretations which are involved from an Ind AS 115, wherein if whether the company can recognize revenue under percentage of completion method, or it will fall under a completed contract method. So just to give a summary from an Ind AS 115, generally we have seen is that Ind AS 115 moves more towards the completed contract method. So this is very, very important when we look at the overall accounting or auditing framework when we audit the real estate. So I just thought to give an entire sense from the revenue recognition, be it from Indian GAAP as well as Ind AS. Now coming to the second part of this slide, I've just summarized some of the key consideration, which generally I think you all will appreciate. We have come across when we do audit of the real estate revenue stream per se. So first point, I think I discussed in detail. I think the key consideration as auditors is that any entity which you audit, what is the accounting policy being followed by the company? Be it Indian GAAP, Ind AS, whether it is in line with the applicable Ind AS requirements of Ind AS 115 or the guidance note, and whether revenue recognition is as per that condition, whether be it POC method or at a completed contract method. So when I say at a point in time, typically what we are trying to say is that the control gets transferred only once the project is completed and the unit is handover. So just to give a flavor, when Ind AS 115 came, I think the audit risk, suppose you are auditing an Ind AS entity which follows Ind AS 115, and based on the evaluation of the terms of contract with the customers, I think the management has evaluated that the control only transfers when I hand over the apartment, which is at the completion stage. I think a lot of risk from an audit risk, lot of, I would say risk, the audit risk is reduced to a very lower level as compared to a revenue recognition at a percentage of completion method. I think that you all will appreciate that. In a completed contract method, it's very clear. You will anyway hand over only once you have got the 100% consideration. You would have physically handed over the apartment. So from a revenue recognition, I think a good comfort level we get from an Ind AS 115 as compared to a percentage of completion method. Second, one more pertinent issue, I think of late, I think every time I discuss on seminars or our internal KC meeting is that how to account for a barter transaction in a real estate company. I think when I say barter transaction, these are typically referred to as JD agreements. So just to give you a sense of a business model, I think we all have seen from a real estate residential developer, there are a lot of models, right, by which I do a revenue business model. I will directly purchase land and construct the development of that project in that land and sell it to the customers. Of late, there has been a lot of asset-light model wherein the entity doesn't purchase the land from the landowner. It enters into a joint development agreement. That's the terminology what is being used generally in the industry. So typically in the joint development agreement, how it happens is that the landowner will contribute his land. He will give the land rights to the entity which you are auditing, which is the developer. And the developer will construct the entire residential projects. And in consideration of the land, I will be giving him a certain constructed, completed area of the apartments. So that is what is meant by the barter transaction. And this is typically prevalent in many of the states in India, JD arrangements. Now, the key consideration here from an audit and accounting is that how to account for this barter transaction, right? Because currently there is no guidance which was available under Indian GAAP at least. So there were a lot of varied practices, but under Indian GAAP, since there was no such literature for a barter transaction, typically whatever the land rights which the company is getting, okay, it was being accounted in the form of construction cost which I spent for the units which I'm handing over. So under Indian GAAP, there was no separate per se accounting of the land in my books of the developer. It gets subsumed in the construction cost for the project. So that was one element in Indian GAAP, though there were certain accounting thoughts were there that whether I should fair value the land which is coming in my books and do a revenue fair value of the construction service. But with typically in Indian GAAP, there was no specific guidance, and majorly people were not doing any accounting of the barter transaction. It was just the entire construction cost which I had to spend for the entire project was coming in my books as a pure construction cost. Now coming to an Ind-AS framework. Okay, now Ind-AS framework, there are two standards which typically deals with this barter transaction. One is Ind-AS 38 on intangible assets, and the other is Ind-AS 115. Now both these standards, what it says is that if there is any exchange of a dissimilar goods, okay, if there is any exchange of any dissimilar goods wherein one entity is acquiring an asset and in consideration it is giving a non-monetary asset, I think both the asset which you are getting in and the construction and the service which you are giving has to be fair value. So this is one important aspect which as auditor we have to be mindful to see whether the company has any joint development arrangements and whether it triggers any accounting under the Ind-AS framework. And generally, when I say Ind-AS framework, based on Ind-AS 38 and Ind-AS 115, what typically happens is that what it entails is that the entity has to account for the land cost upfront. The moment it has entered into JD agreement, typically what happens is that the landowner will gives the developer a power of attorney, POA, which is called power of attorney, for transfer of the entire development rights on the land. So that's sort of an intangible asset in my books. So I will account that the entity would need to account for that land at a fair value. And there are various methods by which you can ascertain the fair value. Either you can ascertain the fair value based on the land which you are getting in the books, or you can even ascertain the fair value of land based on construction service which you are giving, right? Because typically in JDA, what happens is that you get the land and in consideration, you are giving a certain area of the apartment to him as consideration. So the one more approach is that to determine the fair value would be based on the fair value of the construction service which you are given. So that is one aspect under Ind-AS 115 which becomes very critical. How to whether the management has considered any accounting of land which has been received under JD agreement. Second most important aspect is that now coming to 115, what is generally happening is that you as a developer, you are providing then a construction service in lieu of the land which you're getting in. So there is one requirement in Ind AS 115 where it says that any dissimilar goods, if there is an exchange, you have to account that as a revenue transaction. So what it encompasses is that whatever construction service which the company is giving to the landowner, you have to account that as a revenue transaction. So you will account revenue again based on the fair value of construction service you have provided. And the related cost, anyway, you are already accounted the land cost will come in your books. So while it is P&L neutral, I think what Ind AS says is that it's more of a gross accounting, wherein you will account for the land which you have got. If it in substance, it's more of a sale of land by the landowner to the developer, and the corresponding construction service, you will be accounting it as a revenue item. So this is one key aspect which I thought just to highlight from a JD arrangement, which will be equally important. Coming next to the multiple elements of separate performance obligation. So just to give a background, typically we all know that in a residential real estate residential project, right? It's a composite contract, right? So the entire agreement at the end, the developer will give a completed apartment with all the amenities around it. When I say amenities, be it swimming pool, be it the common area and all that. So there is a detailed guidance under Ind AS 115, wherein the management has to evaluate, is there any separate performance obligation within the contract which I'm entering, which a developer is entering with the customer, which is distinct from the original sale of apartment. So if it is distinct, then what it entails is that you have to carve out that performance obligation and recognize revenue separately. So I'm just giving an example. Suppose you have an agreement with a customer wherein the entire purchase consideration is anyways fixed. It encompasses the entire construction cost of the flat, the land cost is embedded, the common area is embedded, and it even includes the club membership fee. So while under Indian GAAP also, if you ask me, there was no clear-cut guidance principles. Many companies was even including the club membership fee and all together as a composite consideration, and they were recognizing revenue in line with the revenue recognition policy of the main apartment sale. Now under Ind AS 115, what it says is that if that club membership fee is distinct from your obligation to deliver unit, which is your primary obligation is to complete the entire project with all the amenities to the customer, and club membership fee is a distinct performance obligation, then the entity needs to carve it out and recognize the revenue only when that performance obligation is completed. So in our case, what happens is that the club membership revenue would be more of a service income. Generally, the entity would need to recognize the income. It may so happen that you would have got the amount from the customer, but the revenue recognition will only be recognized at the end when you complete the entire clubhouse and it is being granted membership to the customer. So that is one of the examples I think I just wanted to give from a multiple elements contract when as compared to the Indian GAAP standard. And another, I think, key issue from an accounting which we have encountered is accounting for delay compensation. So this, I think we all have seen because of so much of project delays which companies have done, how to account for this delay compensation. Okay, so generally there are two varied practices which are being followed. Many entities choose to account this as a period cost. So when I say period cost, they used to charge it to the P&L, the delay compensation. But under the Ind AS framework, it's a adjustment to the transaction price. So when I say adjustment to the transaction price is that delay compensation, ideally, it is linked to your apartment sale. So from an accounting consideration and also while auditing it, I think we have to ensure that the delay compensation is ideally adjusted with the revenue rather than showing it as a period cost. Then again, another typical challenge which we encounter which we have encountered when auditing on the sale of residential sales is that we have to be very mindful of, are there any agreements with the customers with a buyback obligation clause? So many times what happens is that because of the policy which being followed, or to recognize more sales, the entity may enter into schemes with the customers, wherein they will have they will commit to the customer that they would have effected the sale of the apartment. However, with a clear-cut commitment saying after a prescribed period, the customer has an option, okay, to give the apartment back to the developer at a predefined price. So this is called the buyback obligation clause. And this is more to incentivize the sales, because by that 2-year or 3-year time period, the general perception of the real estate developer is that the price will go up. So there is no way the customer is going to give it back to the developer. But of late, we have seen many cases, especially on this COVID scenario and all that, there were a lot of requests from the customer exercising this buyback obligation. So the key aspect here is that any buyback obligation or any contingent condition in a real estate sales, ideally you should not recognize revenue until and unless that period has been lapsed and there has been no uncertainty as regards the buyback obligation. So till that point of time, the management, the company should not, the entity should not recognize any revenue if in case it has any of these clauses, contingent clauses in the agreement. And why I'm highlighting is that sometimes it may even happen based on our review of the documents. Maybe we sometimes may not get the correspondences also that where the company has this scheme. So it becomes very, very important that we first inquire with the management. Is there any such schemes which the company has introduced and backed by an external confirmation from the customer, so that at least from our audit documentation, we have adequate evidence to show that at least we have considered all such cases of buyback obligation wherein the revenue has not been recognized. And again, as I said, that it's more of, sometimes this buyback obligation is more of a separate letter which they issue to the customer. I think it's equally good to take a management representation on this, any sort of schemes like be it buyback obligation, saying that apart from these cases, or there are no cases of buyback obligation from a representation purpose. Another important point to note is on the onerous contract. So this is typically many cases we have seen that the sales are not happening because of the market conditions and all that. The sales are not actually happening at a faster pace, and then gradually the company has incurred significant overruns. So this is one key evaluation, again from a management side and as an auditor, to ensure that are there any lost contracts. So when I say lost contract, is my estimated construction cost per square feet of the project higher than the estimated selling price? So again, onerous contract evaluation, I'm again dissecting into two. One is Indian GAAP, one is Ind AS. Generally under Indian GAAP, there is the guidance note says that any lost contract you have to evaluate at a project level. So it is not necessary that the management has to go each customer wise to evaluate, is there a loss. So an example, like you will have say 100 customers for which you have sold flats. Out of 100, there could be 10 units wherein the selling price was lesser than the cost price. But as per the guidance note requirement under Indian GAAP, that entire loss contract evaluation can be done at a project level. There is no mandate to do it at a customer level. Vis-a-vis Ind AS 115, I think it is very clear. It is since it deals with revenue from contracts with customers, it's at a customer level. And as per IAS 37 provision, you will have to do, the management has to do a onerous contract at a customer level. So this is something which maybe sometimes what happens in the flow of things when moving from Indian GAAP to Ind AS, wherein the company has to have to consider this from an onerous contract provision. So these were the typical challenges, or I would say the key consideration of late, wherein we had deliberated, discussed with the management to ensure that when it comes to the auditing of these areas, at least the management is aware of what is the accounting requirement to be followed in all these peculiar cases. Moving on. So this is just, I have just summarized the key procedures, or I would say the unique procedures, what from a real estate sector we should perform, or we should get to have, to opine on our true and fair view. So coming first to the revenue recognition transaction, I have just list down in the left hand side, we have just list down what could go wrong, or what are the key risk areas and what are the key audit procedures which as an auditor we should be mindful. So the first one is more from an overall framework. Is there any possibility that the management has done a revenue recognition of an apartment, or booked, has done an allotment of unit, but that transaction is not recorded in books at all? So this is more of a completeness check. Now, considering the nature of real estate industry, I think here the biggest and the biggest audit procedure I would say is to first to understand the process which is being followed by the management. I think the entire IT environment framework, and I think we should discuss with the management what is the process being followed right from the booking of the flat to the entering into agreement to sell with the customer, and what are the possible lapses. So as an auditor, first you should do a test of controls of the entire process, end-to-end process of the booking of the apartment till it comes into the sales register. So that is one of the procedures I think mandatory we are doing as auditors, just to see is there any possibility of errors or misstatements in this process. Second, this is more of a corroborative evidence, which I think, I have experienced personally when we do this transaction. See, what happens is that sometimes because the voluminous of data and all that, it may happen that a particular sale is not coming in the sales register, right? How you will ensure that it is being, the management has missed it, or whether they have considered all such sales. One of the key audit procedure which you can do is that you can map, because the currently how they will have is that all the entities will have one sale register and one they will have an advance from customer listing, because advance from customer listing is more from a fund flow management. So in all the ERP environment or the accounting software environment, you will have an advance from customer listing and you will have a sales register. So one of the key procedures is that we should map each individual sales register which has been booked for a particular period, apartment, with the customer listing. And in case you find out that there is a customer from whom I have received an advance, but it is not coming in sales register, this is one of the key procedure wherein you have to inquire with the management what could be the possible reasons why revenue has not been recognized. So this is a very helpful procedure to identify any areas of why it was not recognized. It could even happen that they have not recognized revenue because it was not falling under the revenue recognition criteria as per the guidance note. Like example, guidance note says that you have to minimum 10% collection you have to get. So that could be one of the reasons. But I'm just saying from an overall audit procedure wise, this is a very useful procedure to identify any revenue which the management has not accounted or with an intention to account it in the next year. This was one. Second, cutoff procedures, again, it's I would say very challenging as compared to we have a product sale, right? Because residential sale, I again told that the entire process, the cutoff procedures, again, you should have a thorough understanding of how the management does the accounting right from the booking to the sales register point. So cutoff procedures, again, you have to, I think as auditor, we have to have a very broad base and professional skepticism mind. Generally, what we do is that we even go and check the subsequent bookings and subsequent agreement to sales made. And generally our experience has been is that there are cases wherein the agreement of, though it has been executed, the date of the agreement to sell would have been pertaining to our audit period. So it is very, very equally important that just don't go by the substance of the sales register we check all, say for example, the entire next 15 days or 20 days sales made by the entity and see whether any revenue pertains to our accounting year from a revenue recognition perspective. This is again equally important. Third one, fictitious revenue. So when I say, again, fictitious revenue, it is more of an incentive. Like sometimes it may so happen that the management, in order to boost sales, have actually not find the customer. It has got some sort of advance from a customer with no intention to pay further advance. So when I say fictitious revenue, it is more from a funding arrangement transaction. It could be even from an delinquent debtors. So here it becomes very, very important. 2-3 aspects. First, again, on the testing operative effectiveness of key controls around approval of contract, milestone payments, controls over collection of customers. So if you find that any customer, when you do your testing of operating effectiveness, if you find that there are certain categories of customers who are never being issued any demand notes for construction progress, they are not sending any reminders, I think that's a red flag which we should inquire with the management. What is the intention? Why is that the management not following up for collection? Or there are no approvals around the sales made to that person. Secondly, most important aspect is that testing of journal entries around that. Third, this is again a very, very useful evaluation, wherein this is more from an analysis of any overdue debtors. Again, as I mentioned, you compare your entire advance from customers listing with the amount as per demanded by the company to analyze any overdue debtors. Here also, there could be some corroborative evidence which you will get saying that, I'm just saying an example, I had sold an apartment to a customer a year back. Okay, the same project I have demanded, the sales team has demanded 80% of the amount. Whereas I have only received, the company has only received 10%, which is the initial booking amount. So that clearly shows that there is no intention whatsoever by that customer to pay the amount. This could be something which, again, we have to discuss with the management and ensure that whether there is an uncertainty of collection of revenue, or is it a sort of a customer which is not actually being sold to the right customer. So this is something which evaluation which we can get when we do all these procedures. Another key aspect, I think, from a residential thing is that how do you ensure that the units are not sold, are not sold at a lower than the benchmark rate. So I think this is again a very, very challenging aspect from an auditor perspective. And generally what we have seen is that we generally discuss this with the management. I think the first and foremost is the framework around whether management has any framework around the sales policy. So when I say framework around sales policy, because this is a very high risk area in a residential sales, generally we should begin the question or inquire with the management saying that, is there any benchmark rate? Because a company will have various projects across its portfolio. They should have the salesperson or the sales team should have a benchmark rate which is timely monitored, whether the company has fixed that benchmark rate, and there is a clear policy alignment across all the project heads saying that any sale which is being made below this benchmark rate, there has to be an approval. So I think this is the first and foremost control check, I would say. Again, linking it back to our audit of the internal control framework as well. I think very, very important as auditors, we ensure that there is a control framework around the listing or the unit rates for each project. At a minimum, there has to be a unit rate so that at least we get a comfort that this is what the management has communicated across the board. And any rate below that will go for there should be an approval mechanism wherein there is a concerned person who approves, and it's typically in the way of discounts which has been given. So I think these two, from a broad framework, has to be minimum be there. If it is not there, then we have to see how comfortable we are from a appropriateness or correctness of the revenue recognition. So this is another key aspects which we have to consider when auditing the unit price per apartment, and again at a different point of time. Another critical aspect is the revenue recognition criteria. Again, as I mentioned, I think percentage of completion, if the company is following percentage of completion method, by and large, we have seen that it's only a quarterly control or a yearly control. So generally our experience is that we have to reperform the entire percentage of completion method to assess the computation. I think it's not just test of controls around it. I think this is a very key impact to the financial statement. So it's always better that as auditor, we reperform the entire percentage of completion computation which has been done by the management to ensure comfort around that. Another important aspect is the construction estimates. I have highlighted, as you see, updated estimates not used. I think this is by and large the most significant audit risk area when we do audit of around percentage of completion revenue. So as all of you know, right, the entire percentage of completion method is based on the construction estimates. And there is always a possibility that the estimates are not updated on a timely manner. Now, what is the result of that? If the management doesn't update the estimates on a timely manner, of course, the reason would be that you will be recognizing a higher revenue during that period. And as you move closer to the closure of the project, and by that time, if the management identifies there is a change in revision, you will have a huge cost overrun during that period. So there are two aspects here as auditor we have to be careful. First, has the management undertaken timely update of the estimate? And if yes, that has the management taken the updated construction estimates in the POC computation? Because in case they have done the updated construction estimate, but it has not been factored in the percentage of completion method, then it's an error from that side. And to that extent, your revenue is overstated, because then you are just passing it on to the next year. So this is a very, very important, I would say, a key focus area. And now how as auditor, you will ask me how as auditor we should ensure. So what we generally do is that there are two, three areas wherein we can get some corroborative evidence around it to ensure that the construction cost estimates, what the management has currently given, it's adequately updated for the balance cost to come. So one key thing what you can do is that in this case is that, suppose I'm just giving an example, in your books, your percentage completion method is 60%. Now, we all know from an operational control, most of the companies demand customers the demand letters based on construction link payment. So there are various methods by which the developers demand money, collect money from the customers. One is construction link payment, one could be time-based payment. But wherever you have a construction link payment, the key step is to corroborate. It won't be matching pie to pie, because the books POC may be different as compared to a physical POC. But at least to have a corroborative evidence, you can analyze the percentage of completion which the project team has shared to the customer when they demand the money vis-a-vis books. So it's there in a case wherein in books it is 80% percentage of completion, whereas I have demanded to the customer only 50% or 40%. Then there's a significant deviation between what the actual physical progress vis-a-vis the books. So that gives one of the indicators that the estimates may not be updated. So that is one of the procedures which you can do to corroborate it. Second is that we generally do is that the site visit, and this has been again helpful for big projects. So when I say site visits, again, the objective is not to physically, because it's a civil structure, but generally I have seen is that for large companies where they have big projects and all that, the projects will have 10, 15 towers, and towers, the period of completion would be for 5 to 6 years. So what we should do from a project site visit is to understand the understanding what we got when we discuss with the finance team from an entire project profile, and then corroborate when we go to the site visit. So I'm just giving an example. Suppose in our books, the company has said that the project has 10 towers. Okay, and this is the percentage of completion method. And when we go to a site visit, we actually came to know when we do a site visit, when we inquire with the project person, that the entire project comprises of 15 towers. So that is something which gives us a corroborative evidence in the form of saying that at least then my estimates are curtailed only to 10 projects, vis-a-vis it should have been for a 15 tower. So this is something which, again, I'm just saying more from a broad comfort level, from a percentage of completion basis books as compared to the physical progress we should do. Third important thing is that almost all the companies have this an MIS report, which is called cost to complete report, which will be separately undertaken by their estimation department and project department. It is very, very important that we get from the management an updated cost to complete report, and again map it with in our books as per the percentage of completion method, what is the balance cost to come. This also gives us a very comfort level when we compare with that cost to complete vis-a-vis the books in control. And this is all I'm saying, additional procedures in addition to testing of all the operating controls around the approval and all that. We all know, right? When you see from an ICFR testing, the management will give you an approval. The management will give the signed estimates, budgeted estimates and all that. But these things, be it site visit, comparison, all these will give you a corroborative evidence to ensure additional comfort of whether the estimates are understated or not. So these are some of the key procedures which will help us to address this concern. Again, one more from a percentage of completion method is that the incorrect revenue recognized. This is again a very what could go wrong, which I have observed over the years when auditing the real estate sales. What typically happens is that year one of the launch of the project, the developer would have sold an apartment and say the cost of the apartment is 20 lakhs. Year four, when they hand over, actually the price is finalized at 15 lakhs. So there is almost a 5 lakh difference, which was agreed upfront. Okay, so how as an auditor, we will ensure that this thing is not there. So here, ideally what happens is that there will be many cases wherein the customer gives an upfront payment. This is more of a customer funding the project. And typically in a typical real estate sales, sometimes the customer, whoever customer has entire ready cash with ready amount with them, they pay the entire amount upfront. Now the understanding in such a transaction would be that since the customer is paying the entire consideration upfront, at the time of handover, I will pass on the interest benefit to the customer. So how to identify these sort of transaction? Again, one of the key procedures is that map the advances received vis-a-vis the POC revenue recognized. So suppose the advance received is almost 80-90%, whereas POC revenue, percentage of completion revenue, is only 20%. It just gives an indicator. We have to discuss with the management, inquire with the management. Is there any funding? Is there any upfront discount which has not been updated in the sales register? So this is something which many cases we have found that the management has not timely updated the discounts schemes in the sales register, and we should be mindful of that. Again, from our sample selection, many times review of customer files. Again, it's a very, very important procedure wherein we have to review the customer files to understand is there any further update to the sale price, what has been done. Because a typical feature of a real estate sales is that once it is entered in the sales register, there are chances that there is no update to the sales value vis-a-vis what is committed to the customer. And this is very common. And that's why we corroborate that with the review of customer files. One more important is that confirmation of balances. And this, from my personal experience, I think we are able to get the confirmation from the customers. I think most of the customers we are getting. I think the first concern was that if we roll out, where the customer will confirm. So it is good to roll out customer confirmation balances, not just the balances, with entire details. Typically, what we do when we roll out confirmation is that the project name we mentioned, the total super built-up area we mentioned, because that again is a very key criteria when it comes to percentage of completion method. Then we even mention the total agreement value and the total advance received in lieu. So this is again one of the key criteria from the audit procedure perspective. I think the last one is pretty much simple. It's more from a completed contract method. This is more from an Ind AS 115, wherein typically how you will ensure that at the handover the company is recognizing revenue, what all are the typical documents which will be, which as an auditor we would verify to ensure that the revenues is recognized on handover. Moving on, I think one more key aspect from a real estate perspective is on the advance paid towards land procurement. I think this is again a typical feature of any real estate company. I think as all of you are aware, I think the life cycle of a real estate company, I think this process of acquisition of land and till the project is getting approved and launch of the project is what they say. There is typically, it ranges from almost a period of 1 year to a 5 to 6 to 7 year process. And there are a lot of activities being involved when you get the land and by the time it gets launched to the project. So it becomes very critical from an audit procedure, how comfortable as auditor you are on the existence or the recoverability of the land advance or the monetization of the land advance. Because this is not as if it's both sides, right? The management will say that I have given a land advance, I'm in the process of acquiring the land. So there is no recoverability issue. But on the other hand, there could be various cases wherein the land aggregator or the other person doesn't have the financial capability, and then it goes to a recoverability scenario. So it is a very key area of concern from an audit process. So first and foremost, from an land advance is to understand the process, because typically we have seen is that this entire land advance process, it is the higher management who gets involved in it. So be it the entire process, I think the company should have a robust process around the procurement of the land. So as management, when I procure a land, what all are the key things, whether it has been appropriately authorized by the governing body, whether there was a legal due diligence being done by the management, market assessment. So these are some 3 or 4 documentation areas which we should get from the client just to assess more from an overall business sanctity of the advance given. Next, again if you see, next is from an existence or rights and obligation. So how as an auditor, because this is on a continuing basis. Like suppose you have a land advance, which is an aged land advance. Okay, how as an auditor you are comfortable that there is no recoverability issue or there is no concerns from management side that it not being converted into a land stock. So here is one of the key important aspects which generally we have seen is that verify the underlying agreements or MOU entered in connection with the land advance, with a special emphasis on the timeline mentioned in the agreement. So many times what happens is that there is a timeline being mentioned for procurement of land, and that timeline has elapsed. And after that, there has been no update further from the management. So this is something which we will be we have to discuss with the management. Is there any need for an updation of the agreement? Is it like then my advances, what is the status? Is it become recoverable? So this is something which we have to be very mindful while seeing on the timeline mentioned in the agreement. Second could be confirmation of balances from the landowners or the aggregators whom the advances have given. And here it's good to have the confirmation tailor made in such a way that apart from the advance what the companies have given, it is good to get what is the status of the procurement I think that in case if we get it, that is a very reliable evidence to suggest that the land advance is live and management is committed towards procurement of land. Again, the third one which I have mentioned is a typical land aggregation thing. So typically what happens is that in many of the companies, there is the entire structure is that they want to acquire a large tracts of land, but it is again spread into different owners. So it is called, for land aggregation purpose, they will give amounts to various land aggregators or companies. So this is typically the model which is followed. To give you an update, there is in certain states there is a land ceiling act which has been enacted by the government, wherein a company per se cannot own more than a prescribed acre of land. So this is a structure which many companies do, is that from an acquisition of huge tracts of land, they will form many subsidiaries, or they will have various land aggregators through which they will acquire the land. So this is something which is very critical from a compliance with laws and regulation, that we obtain a legal view from the management on compliance from that land ceiling act as well, to give a comfort from a compliance with laws and regulation. Because this is typically a structure which is being followed in certain states where you have large, where the plan is to buy, where there is a ceiling under the government regulation. So this is one thing which is very critical. Again, on the long outstanding land advances, one more critical audit evidence is that we should get a summary from the client management. So when I say summary, suppose I have given a land advances and then there are progress payments being made. So typically as an auditor, what you should consider is that getting an entire from the client management, the status of the acquisition process, along with, generally what happens is that as and when you give further advances for land acquisition, there would be supporting documents which the other party would have shared with the company. We should have this as a part of our audit documentation to ensure that the activities are being happening and the company is committed towards purchase of land. So this is something, two things critical. One is to get the entire summary from the management, the plan. Is it, what about, is there any other litigation, the conversion status, along with the documentation also we should keep in our audit file to ensure the appropriateness of the land advance. Second, again, from a long outstanding land advance, I think it's equally important that we get a valuation report. So typically in long standing out, all these land advance, typically the company will have a right over the other party, okay, from a beneficial interest. So I tell the management to get a valuation report supporting the recoverability. So this is one of the good indicators to ensure that there are no land advance. Suppose I had purchased 2 years back at an X value. Now, if the market has come down, is there any impairment indicator from a land advance perspective? So any long outstanding advances, typically the procedure is to get a valuation report to support that. And in case the valuation report there are any impairment indicators, then it may trigger a provisioning requirement. Another point, again, to highlight is from a litigated land properties. Again, considering the Indian scenario, we have seen there would be cases of litigated land properties, and I think it's equally important from an audit report consideration how, as auditor, we have addressed this matter from an audit report. So here, a couple of 2-3 things is that we should corroborate. Is there any litigation from the review of minutes of board meeting? Because in board or committee meeting, generally they will have a summary of all the material litigations, obtaining of confirmation letters or from the legal counsels regarding their analysis of cases. And generally what I have seen generally here is that since it is so complex from a legal and regulatory matters, I think we have to consider, though management will have a legal view to support of in case of any litigation matters. If as auditors, if there is an uncertainty in that litigated matters, I think at a minimum, we should see from an audit report, either we should give an emphasis of matter or a modification of report, more from a recoverability perspective. So this is something litigated land properties also is a key area of concerns, which of late we have seen from an land aggregation process. Coming to next to inventory and investment property. So this slide typically just key matters from an inventory of residential RE sales or investment property. The first point is around project cost accounting. So from a project cost accounting, the key from an overall framework, as I mentioned earlier in the first slide, I think we should, as auditors, we should have a clear understanding of the management process around vendor evaluation. So this is an overall framework wherein at least we should be comfortable of whether the company has a robust vendor evaluation system. The fallout is that then the chances are that if they don't have a specific vendor evaluation process, then there could be possibilities of overstatement or inefficiencies in purchases. So this is one thing which is a very key consideration, and how we and in our files also, we should document from a vendor evaluation process how robust the management has done the vendor evaluation process. Again, typical from a residential sales, I would say project cost accounting is that from a percentage of completion method, I think the key thing is that the project-wise accounting. So when I say project-wise accounting, suppose a company has 10 projects, right? It should have a robust ERP system so that there is a timely identification of cost centers being allocated to that 10 projects. And this is a very, very key control from a real estate perspective. It could sometimes happen that management has purchased a stock of raw material for project A, but instead of accounting it in project A, it has gone to the cost center of project B, and your entire percentage of completion method will undergo a change. So when I say project cost accounting, I think it's very, very important when we do our test of controls or substantive process while verifying the document, we should be very, very attentive whether the company has a cost center identification process. So when I say cost center identification process, it flows right from the creation of work order or purchase orders. Your work order, purchase order, service order, all are they linked it each to project wise? If it is not linked to project wise, then how management is identifying project cost accounting would become the biggest challenge to audit. That is one of the key thing which we should consider. Another thing peculiar to real estate is that the stock of building materials. So this again, we have seen from our experiences that typically there are two models by which all these real estate companies works. One model I will have wherein the company procures the material on its own account, right? And then it issues that materials to the subcontractor. Okay. And the second model is that the company, the entire project development is subcontracted to the contractor. So even the materials, everything, it is being subcontracted to the contractor. So in the first case, typically the accounting consideration is that in many cases, what happens is that the accounting software may not be updated the moment the company purchases any stock of raw material, be it steel, cement, plumbing items. It goes and sits in your project cost. Whereas as per the accounting standard requirement, unless and until it is consumed, when I say consumed, unless and until it is issued or consumed in the real estate project, it should lie as a stock and not as a project cost. So this is something which we should be very careful, because the moment we treat the purchases as a consumed item, it goes and shoots up your percentage of completion method. So this is something which upfront we should see. One is from an accounting policy for stock of building materials, and second, how are the systems being integrated to identify stocks which are not yet consumed, are treating it as stock and not as a project cost. And then of late, I think we use a lot of data analytics to identify any red flags in this project cost accounting. So when I say red flags, it is more of, are there any non-routine entries being passed for transfer of project cost or analytical procedures and all that. And I think in all this big, when you have voluminous data, various projects, use of data analytics will just give you a corroborative evidence of to identify are there any unusual fluctuations so that we can have discussion with the management. Another point common to the real estate accounting is that typically when you say inventory accounting, it will comprise of your direct cost, and of course you'll have indirect costs also, capitalization of indirect cost, which is your overheads. Also, typically companies inventorize to projects, and typically indirect cost, to the extent it is incidental to the construction activity, the company can do it. But I think the key critical point here from an audit angle is that we should clearly understand the basis of allocation. So when I say basis of allocation, whether the basis or rationale which the management has adopted of allocating the overhead cost, it is inconsistent with the construction progress. So I'm just saying an example. Many companies allocate based on the direct cost incurred. Some companies do it based on area constructed, but it can't be based on area sold. So that becomes very critical when we audit the basis of allocation of the overhead cost to the project. Next, coming to the NRV testing. So when I say NRV testing, so this is on the impairment analysis. So impairment analysis of real estate project broadly will fit into one, you will have completed completed stock of units, and other would be your under construction. So generally we have seen challenges around under construction properties, like how will you benchmark, right? So if your sales are going, if the company is able to sell during the construction phase, I think pretty much you can assess the impairment or do an NRV testing by benchmarking with the current sales price of the apartment. But what becomes challenging is that what if you don't have any existing sales happening of that apartment? How will you do it? So there are 2-3 things we have to be mindful is that if we can benchmark with the recent sales, what has been happened in the vicinity of the project. Now, suppose that you have a project which is stalled. I'm just saying an example, stalled, and you don't have any visibility of the last 6 months or 1 year sale. How you should go about it. So there, I think it is better to get a valuation report from the management to support their estimated selling price, because generally there will be 2 steps. One, the management would have given an assessment of the estimated selling price, what they are planning to sell, and based on which they have done the NRV testing. But it is good to have in our audit documentation file a separate valuation report to support the management in a contention of the sales within that market area, so that to ensure that there is no impairment from an ongoing projects. Another one peculiar, I think one of the audit procedures which was very helpful for completed projects. So typically what happens, I'm giving you a scenario wherein you recognize revenue based on percentage of completion method. And one of the key data points is the total saleable area. So how it typically works is that you have a total saleable area in square feet, and then you recognize revenue based on area sold. Sometimes what happens is that based on updated project plan or something, your total saleable area would have got curtailed, but it may not have been updated in your sales register. So how you are comfortable on the entire saleable area estimate which the management has done. So one of the key audit procedures which is good to have is that you should do a reconciliation, and this you should do a timely reconciliation of the unsold SBA, which is there in our books as per our sales register or purchase, or as per our POC computation. The unsold SBA has to be mapped with the management report of unsold stock. So this sometimes gives a comfort on the entire completeness of the project SBA. It could be so happen that sometimes, as I told you, the SBA would have undergone a change and my total sale area has come down. Whereas in my books, I continue to account it as an inventory. Vis-a-vis, it should be charged to P&L. So that is something which reconciliation of unsold SBA to sales report is a very good audit procedure to give an evidence of there is no inflation of unsold SBA to that extent. So these were the broad matters from a residential sales. So residential sales, revenue, land advance, inventory. Now I just have just couple of items from an investment property, and which typical challenges which we face is on the determining the capitalization of building. This is again something which a lot of discussions happening between auditors and management on the date of capitalization of a commercial building. So I'm just giving an example. Suppose the management is undertaking a commercial development for leasing, and at a point in time when you are signing the year end March 22, the project is 80% complete, but the company has got the occupancy certificate. When I say occupancy certificate, a completion certificate from the government authorities saying that the project is complete. So whether the management should capitalize the asset based on the occupancy certificate or whether it should wait. So typically, if it flows from an accounting angle, it's very clear. The entire building, the bare shell, the civil structure has to get completed. The standard is very clear. It says that it has to be capitalized when it is ready to use, right? So these are the some challenges which we face, wherein the occupancy certificate or the completion certificate you would have got, but there are significant pending items. So in that case, typically you should take a confirmation from the project manager, project team saying that this much of civil works is still pending. Those have got the certificate from the regulatory authorities, and we should corroborate that by doing a physical verification of the site. That was one aspect. Second, from an investment property, another key aspect from an investment property is on the impairment assessment. So impairment assessment, when I say investment property, is all rent yielding assets. So in the COVID scenario, this was a very, very key important audit area for auditors to ensure that none of the investment properties are impaired. So there are two approaches here. Generally, we follow as an auditor. Suppose you have a completed property which is 90% leased, say for example, 90% leased, you have good rentals, your historical cost, it is at a historical cost, the land and building. You can, as auditor, rely on the management valuation. The management would have done a valuation internally. We can do certain procedures, and I think if we are comfortable, that's a huge headroom. I think it should be sufficient. But of late, we have seen many cases post this COVID scenario and all that, and especially scenarios where the company has recently capitalized the project. Okay, there could be probable possible impairment indicators. Like I'm saying, the occupancy is still not, the leasing has still not started. Wherein 1 year has elapsed, but the leasing pipeline still is not showing improvement. In all that cases, it becomes equally important that a management undertakes an independent fair valuation of the investment property. And as auditors, we do a review of that. And here also key considerations are that from an auditor perspective is that we have to thoroughly review the assumptions around the valuation report, again into two buckets. First is the input data. So generally, the input data from a valuation of investment property would be your total lease area, total tenants, rent roll data. So all that you can corroborate with the information what you have in the books. Second would be your management assumptions when they did a fair valuation, and typically the fair valuation for an investment property would be under the DCF, discounted cash flow method. So here also we have to be very careful when we audit the estimates around the DCF model. So typically the estimates or the assumptions would be the growth rate, the WACC rate, the leasing profile and all that. So these are the key items which we should audit and thoroughly review, that we are comfortable with the assumptions which are being used for the purpose of arriving at the fair valuation of investment property. Because as you all know, under Ind AS, we generally don't do a fair valuation accounting, it's only for disclosure. But from an impairment assessment, it becomes equally more important to review these fair valuation reports. Next is on the related party transaction. So related party transaction, this I have bifurcated into two things. One is the typical loans and advances, which ideally in any real estate company, typical structure is that the holding company is the flagship company. Then it funds all their group companies, all their operating assets of group companies, and they give loans to the group companies for running their business operation. So how you should, the key concern there would be how you are comfortable as auditors on the recoverability of the loans and advances which are being given to the group companies. That is one. And second aspect is on the, and other than that, all the related party transaction. So if you see investments, loans and advances, typically one is from a compliance with laws and regulations, wherein as auditor, we have to verify all the necessary board approvals for providing such loans and advances. The business rationale, I think of late, this has become very, very critical. Typically, one of the aspects I think we all see in real estate companies is that the company gives loan, interest-free loan to the group companies, right? Now, as auditor, if you ask me how comfortable you are, whether that interest which they are not charging to the group companies, is it prejudicial to the company? That is something as auditor we should evaluate. So I'm giving an example. Suppose there is a holding company, there is a 100% subsidiary. The holding company is giving loan to a subsidiary without charging interest. I think we still have a business rationale to support that. It is my economic substance. I'm giving it to my subsidiary company, right? Ultimately, the economic benefit will flow to the holding company. So accordingly, management does not charge interest. I think pretty much from a holding subsidiary relationship, it should be fine. But suppose a group, the holding company has given to a group company wherein I don't have any economic interest. The company which is giving loan doesn't have economic interest. I think that becomes very critical from an auditor angle to evaluate whether the not charging of interest, whether it is prejudicial to the interest of the company, both from a main audit report as well as from a Caro requirement. And this is something which I have seen is coming a lot of scrutiny from other regulators, bankers, lenders, and all that. So this is something which is very, very important to see, to understand the entire business rationale and the benefit what I'm getting if a company is not charging interest on loans to the group companies. Second, many times what happens is that you would have given loan to your group companies. The group companies would have undertaken for real estate activity, but because of some reason or so, it is being long outstanding. The group company has still not refunded it back to the holding company. So one of the 2-3 key aspects there as an auditor, I think we should evaluate is that first is of course on the valuation. You should take a valuation of the underlying business which is there in the group companies to support that, okay, at least I'm comfortable that there is an operating asset which is being there and the other company is adequately protected while repaying back to me. That is first step. Second is that I think there is a lot of onus now on auditors to see the end use utilization of the loans. So one of the key audit procedures which I do generally is that wherever loans and advances which have been given from my auditing company to the other group companies, you have to review the financial statements of the entities to whom I have lended to see the audit trail or the fund flow where it has been used. If it is being used for the purpose of business, because that is exactly why I am giving it to my group companies, it should be fine. But just to ensure that the end utilization is as per the terms of the lending, it is very important that we review the audited financial statements of the entities for whom which we have been given the loan. And third, again, from a documentation, as I said, equally important, inquiries with the management on the project status, future business plan of the entities to whom which advances have been given. Because many times what happens is that there could be some impairment issues. If the business operations of that entities are impacted, then of course, as from my perspective, the company which is lending the advance, there could be an impairment indicator. And just generally will come to know only by a thorough review of the financial statements, inquiry with the management, taking the status of the project which is there in that company. So again, this is a very, very important aspect. And generally, we have seen many cases there has been a provisioning trigger as well from an accounting perspective. Related party, again, I think it is inherent to the real estate industry. Very, very important. One is from a regulatory compliance. I think there are a lot of regulatory focus on related party. I think we all will appreciate, be it from Companies Act, accounting standards, SEBI LODR. I think SEBI LODR now has mandated for listed companies to quarterly report all the related party transactions and half-yearly the material related party transactions. So it's very, very important as auditors that at least we see all the documentation around the board approvals, the AGM approvals, the business rationale. It's not just when I say approval, the business rationale of entering into the related party transaction and it being in the ordinary course and at arm's length. That is very critical to get it from the management. The second is that many times we have seen is that there are certain transactions which are being entered into related parties more from it being a very peculiar service and the other related parties having expertise in that. So there also it's very important that management takes a benchmarking report to ensure that there is no the arm's length, to ensure that the transaction is at arm's length. So it is not just that approval. We sometimes have to even tell the management to take a benchmarking or external valuation report to support management assessment of it being at arm's length. This is very important, particularly with the recent focus on RPT transactions. That was one, and then I spoke of benchmarking study. Again, there could be typical. This is something which we had seen in one or two cases wherein you have transaction with related parties with a lot of terms and conditions attached to it. So it is good always as an audit procedure that we get a confirmation from the related party on that particular transaction along with all the terms and conditions so that it corroborates to our understanding. So this is the most, so that we'll get an external confirmation confirming the entire terms and arrangement. So this is one of the key audit procedures which we can do it. Again, from an undisclosed related parties, I have just highlighted 2-3 things which additional procedures which the auditor can do to ensure. As I said, data analytics is something which we do, wherein your entire vendor master, you can get an entire vendor master download from the management and then compare it with all the list of related parties which you have and corroborate whether are there any vendors, related party vendors, and if it is there, whether the management has identified and appropriately disclosed in the financial statements. Again, disclosures from the board members, senior executives, and again, corroborating it back to the list of material vendors is one of the things which you can do. So these are the things from an RPT transactions. Coming to the next slide. Again, these are the key typical challenges which we have encountered. One is on the borrowing cost capitalization. Second is on customer and other litigation. Third is on the recoverability of deferred tax asset. So when I say borrowing cost capitalization, 2-3 important things which by and large we have various discussions with the management. One question was that if I have a borrowed funds, project funds, and I have temporarily parked it in surplus, what should be the accounting treatment? So it's very clear from an accounting standard perspective, any temporary parking of funds, of the borrowed funds, if it is incidental to the project, has to be reduced from the project cost. So this was one. Second, another important pertinent question from an auditing of the borrowing cost is that whether land is a qualifying asset or not. So here it's also, I would say, more of an it's a mix and match of both technical as well as industry practice, where both the positions are there, wherein one view is that the moment you purchase the land, it's ready to use, right? So you can't capitalize anything interest once the land, you have procured the land and you have paid the amount. Another view is that any land which you purchase with an intent to develop it for the purpose of construction, both are interlinked. So land and building together can be treated as a qualifying asset. And this is typically the industry practice of treating both land and building as a qualifying asset if the intention is that you have to develop together and you can't sell land separately. So this is again a practical approach which has been taken by the industry, wherein land and building together can be treated as a qualifying asset. One other challenge is from a the last piece from a borrowing cost capitalization is that how to treat the advance from customers. So you have a project, I'm just giving an example, you have a project which is funded by bank. Now you have even customer collection. When you do your borrowing cost capitalization, whether you should adjust advance from customers. And this is sometimes very typical that management many times miss reducing the advance from customers. So the answer to this is that there are two things which the accounting standard says is that one is the specific borrowing cost. If the management has specific borrowing costs related to a particular project, the entire interest cost on that specific borrowing cost, you can capitalize to the project. There is no need to do any adjustment of advance from customers. However, if the management has a practice of doing general borrowing cost capitalization, if you have a general borrowing and you are capitalizing it to your qualifying projects, real estate projects, you have to be very, very careful. Then in that case, you have to reduce from your eligible capitalization inventory cost, the advance from customer back, because to that extent that's being funded by the advance from customer. So this is something which we have to be very careful when ascertaining the computation of capitalization of borrowing cost. The next is the other two more from again important from a customer and other litigation. I think we discussed more from land litigation. Again, too much focus from customer claim litigation with the advent of RERA and all that. So this is something from a broad overview. I think we have to be very extra careful when we scrutinize all the legal cases and see its impact on our audit report. Specifically, again, real estate projects, if there is a significant litigation matter, we have to even evaluate whether revenue recognition can be continued or not. Because since one of the conditions in the guidance note is that the project approvals has to be in place or there can't be any litigation for suspension. So this is one of the key things which you have to ensure. Another typical challenges which we face, again, from a recognition of deferred tax asset. So when I say recognition of deferred tax asset, suppose you have entities where you have historical losses. Okay, so suppose, and this is typical in real estate companies which are under commercial development. You will have losses because of the huge funding cost. How you should evaluate recognition of deferred tax asset. So here one key important point is to see, because though the management will have profitable projections, it is still possible that you may not be able to recognize deferred tax asset considering the time limit of 8 years under Income Tax Act. So here that practically the solution is that if it's a very, very touch and go situation, as auditors, it's better to do a sensitivity analysis over the deferred tax recognition. So when I say sensitivity analysis is that if the management has given a projections, do some sensitivity analysis. If my projections go by 5% minus or 5% plus, is there still comfortable buffer for me to recognize deferred tax asset? If not, then we may have to curtail the recognition of deferred tax asset. So this is something sensitivity analysis which has become very key focus considering the current economic situation. And then the last one is on the going concern assessment. Again, this is something which we had encountered or we have seen right in many of the companies, real estate companies, wherein the projects are stalled. And as auditors, it's very, very important that we clearly audit the management assumption of going concern assessment. So 2-3 important points here is as auditors, we have to see, are there any indicators? Like an example, typically in real estate projects, we have seen is that the management has 2-3 indicators that the project, they are not able to sell their inventory, and further, they are not able to repay their existing loans, nor they are able to refinance the loans. So these are the 1 or 2 or 3 criteria which clearly indicates that there could be material uncertainty on going concern. And this is, I'm just saying more from an experience from a real estate sector. These are the immediate trigger points whenever you see your entity which is very highly leveraged and they are not able to, there has been existing defaults in loans and advance in payment to banks or financial institution, or there is a repayment due which the management very well know that there is no possible funding option and there is no support letter from the holding company. So these are something which came across 2-3 indicators wherein we have to be very careful when we do an audit of the going concern assessment. I think with this, I come to the end of all the key consideration from an audit. Happy to take any questions. Yeah, Anilji.
Thank you so much, sir. Thank you so much for such a detailed and wonderful deliberation covering all the aspects relating to the auditing, relating to the real estate sector. Sir, I have received certain question.
Yeah.
Relating to this. First is, sir, why company shown as collaboration advance for related party loans, as a related party loans?
Why company?
Generally show collaboration advance as related party loans.
No, collaboration loan it is not collaboration loan. Generally, related party loans are in the form of either investments or loans and advances. Collaboration, I have not seen collaboration. Collaboration, when I think what the question would be more from a collaboration with the landowners. That ideally should not be shown as related party. It is more of a joint development agreement loans.
JDA.
Yeah, JDA. Collaboration is more of a JDA transaction. And again, it depends. If it's if your collaboration agreement is with a landowner who is not a related party, then it won't be as a related party. But the question, I think, what the person says is that if you have a joint development agreement with a landowner, okay, and the structure is of a joint venture arrangement, then it could be a related party.
Okay.
Vis-a-vis a pure purchase of land. Exchange of land.
So if the land is capitalized in the books of accounts and the company wants to use this land for the project, can it be transferred the land to stock? If yes, what would be the process?
No, I think two things. What I didn't.
Land is capitalized in the books of accounts and the company wants to use this land for the project. Can it be transferred to land to the stock?
Yeah.
If yes, then what would be the process that land is to be transferred in the stock?
Yeah. So this is regarding transfer from an investment property or fixed assets to inventory. So what the standard says is that first, I think here initially the management would have a plan of using it as a capital asset. So it has capitalized in its books of accounts. The moment if you want to transfer it to inventory, I think there is a clear accounting standard requirement. There are two things here. One is the management should have an appropriate evidence in its with them, wherein they clearly demonstrate that there is a change in plan use. When I say change is from a leasing model, now I want to sell it to the customer. So if the management can appropriately give documentation around change in plan, then they can, of course, transfer it from your fixed assets to inventory. And then there will be a related income tax trigger, also more from a capital gain. But otherwise, the key thing is from an accounting is that there should be an evidence supporting the change of plan use from an investment property to inventory.
Okay. Sir, sale of plots, net of sale return has been disclosed negative figure in the profit and loss account while auditing. How it is possible, sir?
Yeah, so I think this case, what would have happened is that see all these entire sale of plot, sale of apartment, it's more of an YTD computation because the way percentage of completion works is that year one you have sold 40 flats, year 2 60 flats, so 20 is incremental. Now, what in your case, I think what he is trying to say is that there is one peculiar scenario wherein your sales during the year is say 4 units, 4 plots, but reversals are 6 because that's recognized last year. Now the customer has cancelled. Okay, so I know it's a peculiar thing. I think the key thing from an auditor perspective, if you ask me, is that we should first validate was the earlier recognition of the plot in line with the terms of the agreement, no cancellation issue, no collectability issue. Then it's just a factual thing, there will be a negative thing. But more important would be to ensure that there is no prior period issue involved here, since it is showing a huge reversal of revenue.
So where the developer makes an agreement with the customer to rent out the apartment for a period of 2 to 3 years with an option to buy at a discount of a certain percentage on the current price after completion of said 2 3 years. How do we account in this scenario?
No, I think you're leasing. I think what the question is that the customer buys the apartment, right?
Yes, where the developer makes an agreement with the customer to rent out the apartment for 2 to 3 years.
Okay.
Again, then there is option to buy at a discount of certain percentage on a current price after completion of said 2 3 years. So how do we account?
So I think there are two issues here. What I understand from the question, one is that there is an option wherein the developer is saying at the end of 2 or 3 years, I have an option to, the customer has an option to give it back to the developer, correct?
G.
And second is on that during the construction phase, the developer will pay some rental, fixed guarantee sort of thing to the customer. So the first one, wherein there is a option which is being given to the customer, saying that after 3 years or 4 years, you have an option to give it back to the developer. From a developer perspective, I have no control over it. So that's what I told initially also. It's a contingent event linked to a revenue recognition. So very clear, you can't recognize revenue day one when you enter into an agreement with the customer, because you are giving an option to the customer to that he can give it back to me. So unless and until at the end of 3rd year, 4th year, if the customer decides that point of time that, okay, I will retain, then only on that point of time, you will be able to recognize the revenue. Second point on that payment, I think what I understand is that payment is because of that. Many times the developers comes with a scheme saying that I will pay you the rent for that 2 year, 3 year period. Since it is the rent payment is linked to your acquisition of apartment, ideally, broadly, we have seen the accounting treatment ideally should be a reduction to the revenue than showing it as a cost. That's the preferred approach.
Sir, which method will be better, whether on turnkey or cash basis of determination of cost of construction?
Whether on turnkey?
Turnkey or cash basis for determination of cost of construction?
No, I didn't get. I think what he's trying to say, cost of construction would be based on your accrual method of accounting in books. Yeah.
We will take it later on, sir. I'll forward it to you, then we will mail the same.
Sure, no problem.
Yes. One question is, sir, kindly elaborate more regarding the accounting for barter transactions like JD arrangements and also the nature of such transactions.
Yeah, so this, as I discussed, so typically what happens in real estate, and this is across many of our states in our India. As I told that typically one model is that the developer purchases land, upfront land from the landowner, and it pays a consideration. But there is one more model of joint development agreement. It is coined as joint development agreement, but the substance is that I find one landowner, okay, and it's an asset light model. I find a landowner. The landowner has, I'm just giving an example. He has 2 acres of land with him. He transfers the entire development rights of the land to me as a developer without any consideration, without any cash consideration. Now, how it will happen is that he will give me his development rights to me as a developer and tells me, the developer, saying, you construct in this a residential project whatever be the fair value or the cost of the land, say for example 2 crore, you give me equivalent area share once you complete the project. So what happens in this scenario is that from a developer perspective, I did not incur any upfront cash because it's a barter transaction. I get the land upfront. What I will lose is that once I construct the apartment, I have to give him a specified area of the apartment to him. And for him also, it's a win-win situation because landowner, what will happen is that he will get an upside. Say 3 years ke baad project khatam hua. After 3 years, the price may go up of the apartment. So that upside also he gets. So it's a win-win for both. And this is typically, the economic substance is very clear in this. It's not a joint arrangement. Okay, because he just gives me the land, the entire construction risk and rewards is with the developer. I am involved in the development, I am involved in the marketing, I am involved in the sale. He just gives me land, you just give me the constructed apartment. So if this is a typical joint development agreement, and what I was trying to say is that from an perspective, under Ind AS 115 framework, ye barter transaction, you have to account at the fair value. So when I say fair value, whatever land I get, the developer gets, they have to account this land at a fair value of at the fair values. Now, how will I recognize the fair value? There are 2-3 methods prescribed in Ind AS. It could be fair value of the land what I have got, or the preferred approach is that how I'll do the fair value of the land what I have got is that jo bhi construction service I am doing for the landowner, that landowner construction service, I will do a fair valuation of that construction plus margin basically. And then that fair value I'll account as a land cost. So that is step number 1. Under Ind AS framework, it tells to account for the land cost in my books at a fair value. The corresponding credit will go as landowner payable. Why it goes at landowner payable is that because I have construction obligation, correct, to give it. Now the second aspect under 115 is that whatever construction service I'm giving to the landowner, it's a revenue activity. So that construction service what I give to the landowner also, I will account it as a revenue in my books. And jo construction cost I incur, I will charge to P&L. So in net and net under Ind AS, what happens is that I will gross up the land area, landowner ko jo bhi area de raha hu, I show that also in my revenue as my books. Correspondingly, land cost also I will show as cost of sales. So it's more of a gross accounting, but this is what is required under Ind AS 115.
Sir, as per the Schedule 3 requirement, aging of the CWIP is required. What documentation is obtained regarding CWIP should obtain plan estimate cost and completion estimate.
So there are two requirements under Schedule 3. One is on the current capital work in progress aging, which would be based on incurred cost, we will give an aging. Second is on the estimated completion date. I think his question is on the estimated completion date, how I should give the aging. So that estimated completion date, you have to give based on your updated estimates. It has to be based on updated estimates. Jo bhi aapka updated estimates hai, there, what is your planned completion date? Based on that, you have to give the aging for completion.
So in 2011, there was a Supreme Court judgment which said that the sale of immovable property with power of attorney is invalid. There was a sale that took place and duly registered with POA. What is the stand of auditor in that case?
No, that was more from a sale. Here power of attorney, we are still, there are two things here. One is from a legal compliance framework and another is from an accounting framework. From a legal compliance framework, I don't think it will impact from an accounting, because legal compliance, what they are saying, trying to say is that the power of attorney is just giving a rights to him. From a transfer of property act, it is still not a sale, but it doesn't impact our, I agree that that judgment had come, but it doesn't impact our accounting treatment.
Sir, in case of pre-launch projects, for the advances received from customers held with the developer, will attract impairment as an analysis? Pre-launch projects for the advances received from the customers held with the developer will attract impairment as analysis. If not, what cases impairment analysis has to be done, sir?
See, so the impairment analysis anyway, it doesn't I think it doesn't matter if you have got advances from customers pre-launch or post-launch. Here, I think in your case, I think the question what he's trying to say is that I have not launched the project, but I've got advance from customers. It's a pre-booking. In fact, it's more of a positive affirmation. But impairment analysis, it won't trigger impairment analysis because here it's more of a positive thing. I have got the advances before the launch. But having said that, what I'm trying to say is that the impairment analysis for an under construction project, we still have, as auditor, have to evaluate the impairment analysis based on budgeted cost and budgeted sale value. We should have a budgeted sale of the total sales, what the management will estimate over that 2-year or 3-year period with the budgeted cost. There should be an adequate margin to ensure that there is no impairment.
So last question for the day.
Yeah.
So regarding the percentage of completion method suggested as per the present Ind AS, there are occasions where finalizing the balance sheet, the percentage pending and to be considered in the next year are becoming a debatable points with the clients, though there are no great technical issues involved. So kindly elaborate, sir, if you put some throw light, sir, on this.
No, I think what this question is more from percentage of completion.
Yes.
No, here and there is some practical issues. How to compute the percentage of completion is what he's trying to say, right?
Yes, there are various occasions where finalizing the balance sheet, the percentage pending to be considered in the next year.
Not considered in the next year. I'm saying
more or less it is relating to the percentage of completion method.
No, I know, but I think what he's saying, whether is there a flexibility of percentage of completion to be considered next year. So I think the standard is very clear. See, from a standard perspective, there are certain criteria. Indian GAAP anyway have explained. Ind AS, it's very clear that if in case you satisfy control transfer over the construction period, at a minimum, you should have a contract with the customer. Your cost at least should have been your physical progress. You should have at least done 10 to 15% physical progress. You will have agreement with your customer. There is no uncertainty in collection. If these 2-3 things are there, definitely you have to compute the percentage of completion. The only possibility is that in case you want to defer the percentage of completion method, is the management trying to say there is an uncertainty? Then I agree. If there is an uncertainty on collection, or I'm trying to say if there is an uncertainty on the level of project progress, I'm still not sure whether it is. I have even completed the basement work. So if the level of progress, it's more of a management representation here, my view. If the management says is that the project has not attained the level of progress for me to do percentage of completion, then there is a possibility of going it to the next year.
Sir, one last question arises. Sir, we have security deposit in books, but the term of lease agreement ended 2-3 years back. Party not demanding the refund of the security deposit. What to do in this case, sir?
So I think here, okay, the other party has just forgotten to demand it. I think, see, generally what happens is that it's more of a risk to the other party, I would say, for the party, because I am anyway a creditor. I have not yet paid it. Maybe he can just reach out to the other party. Is there any technical issues or is there any concerns why they have not demanded it? But otherwise, I don't foresee any issues. I can still retain it as a liability. I don't think we should trigger any accounting of writing back. Okay, because liability, it's always advisable unless an other party waives it off. It is not advisable to give it in. Take it as from an accounting perspective, I'm saying, to account it as an income, unless you have a specific undertaking from the other party saying that, okay, he's not demanding or he's waiving off. But otherwise, I think it should be better to retain it as it stands now.
So thank you so much, sir, for sparing your valuable time, and you have explained in a very lucid manner, in a very detailed manner. And on behalf of WSP of ICI, I extend my heartiest thanks towards you for sparing your valuable time. And in spite of having busy schedule, various audit committee meetings also, you have spared more than 2 hours and continuously spoken on the topic and given time for various questions and justified with the questions also. So on behalf of WSB, once again, I extend my heartiest thanks to you, sir. Thank you so much, sir. Thank you so much.
Thanks. And it was a pleasure sharing my experience with the audience. And thanks for the opportunity.
Thank you, sir. Thank you. Namaste.
Thank you. Yeah, thanks.